Major support for these broadcasts is provided by New York Community Bank, Chase Commercial Term Lending, Chelsea Lighting, Capital One Bank, Perfect Building Maintenance, Genova Burns, Giantomasi and Webster, Kilroy Architectural Windows, New York's Window Company, the Wyckoff Group, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by Ackman Ziff Real Estate Group, Bank of America, Merrill Lynch, Briarwood Organization, Bruce Mosler, C.B. Richard Ellis, Colliers International New York, LLC, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, Levine Builders, DDG Partners, Friedman LLP, Accountants and Advisors, Flushing Bank, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, James Orphanides, Centurion Holdings, John Katsimatides, Red Apple Group, Madison Realty Capital, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, New Banks, Meridian Capital Group, Newmark Knight Frank, Sterling and Sterling, SJP Properties, Stonehenge Partners, and These Friends.
So here we are. It's the fall of 2012. And you know what? We have an election. We have other situations. We have the Fed reducing their numbers down. We're at interest rates at the lowest times in years. So here we determine where do banks want to put out their money? What do they want to do with their money? Who do they want to lend to? So I don't know. So I brought together 4 prominent bankers to provide their insight on where they look at the market in 2012 and 2013. My guests, they include Dominic Kama, the Senior Executive Vice President and the Chief Operating Officer of Investors Bank, Matt Petrula, who is the Administrative Vice President at M&T Bank, Kevin Lynch, who is the Chairman of the Board, President and CEO of Oritani Financial, also known as Oritani Bank. And last but not least, if I don't screw up the pronunciation of his name, my good friend Frank Horoswinski, who is the Senior Executive Vice President in charge of and Chief Real Estate Lender at Flushing Bank, also known as Flushing Savings Bank. Right. So, Frank, where do you see the world today? You know, you and I go back close to 25 years. We remember the world being up and down, and how do you look at it as a bank to be cautious? You know, you want to make loans, but you also want to make the right type of loans. Where's your opportunities? And
we've been looking to more recently develop a balanced portfolio. Obviously, of a thrift model, we had a heavy concentration in real estate, and in more particular, I guess the lower end. Historically, our loan balances were, on average, less than $1 million, significantly less. The past several years have proven that it's a little bit tougher for the smaller operators to get through these difficult times. A few tenants fall behind on rents, they get commercial vacancies, a little bit harder to rebound. So we made a strategic effort about 18 months ago to start to move up market, not to compete with pension funds, but definitely move up into larger loan transactions, which are generally supported by more sophisticated operators. Not neglecting the smaller market, but definitely move up. Throughout the whole cycle, we developed a very balanced portfolio of multifamily, commercial real estate, and I'll call general purpose commercial within the communities we lend in. And we are definitely going to continue that strategy in order to maintain a balanced approach And the purpose of the balanced approach is to, when one sector isn't as strong as the other, you have something coming up behind to help support the operations of the bank, the revenues of the customer bases. So we're probably going to continue that approach, and much like most lenders in today's market, be largely focused on multifamily.
Dom, it was only maybe 9 years ago, maybe I'm incorrect, 7 years ago, that Investors Bank, which was called Investor Savings, really you wanted to lend on mortgages for people. I mean, how big is your portfolio today?
Our residential mortgage portfolio is just about $5 billion.
And your commercial portfolio?
Commercial portfolio is about $4.2 billion. So we've
But from zero.
From zero.
So where do you I've had dinner with you and Kevin. We've spent time. I've heard Kevin and you speak. Where do you see the opportunities and the pitfalls? Okay, because there's always opportunities, but you also have to remember. I was away in Denver, and I was joking with my little granddaughter. I saw this squirrel, and my wife says, "Yeah, Papa always talks about putting away the nuts, the squirrel." So you have to be cautious. Where do you see the good opportunities and the cautious opportunities?
Yeah, I think the best place to start is the pitfalls, because that's where we learned our lesson back in 2005. We got into the construction lending business in New Jersey, Hudson County primarily. Was a lot of growth there. And, I often say the best thing about when we got into construction lending, it was 2005. The worst thing about when we got into construction lending, it was 2005. And my point is that we got in at the peak of the market, which was the bad time, but we also did not have much time to screw it up, if you will, because by '08,
So here's a question that I'm going to ask Kevin to really, why did you go into the construction business in 2005? What was the reason for you to go into the construction lending business? Was it a higher yield? Was the cost of entry easier for you? Or, as we might proverbially say, maybe some of the intermediaries were pushing more on construction than on different areas?
Yeah, I think, it's a little bit of all of the above. The fact is that the economy was booming. Hudson County was growing. A lot of apartment buildings going up there. It was easy entry for us. We were just getting into the commercial business. Also, from an interest rate risk standpoint, we had all these residential mortgages at 30-year mortgages, and here was a way to put on an asset that repriced more frequently.
Kevin?
Yeah.
You've seen the market over the years, and you've seen it even in a different, interesting manner. You've served when the S&Ls, because you were originally an S&L, were allowed to be joint venture partners with builders, and you've done well with that. How do you see the world today?
It's a lot different. In the older times, or let's say a long time ago, people were a lot more circumspect about what they would build, and there was a little less speculation. In the '05 to '08 period, there's a tremendous amount of speculation because of the red-hot prices, and we all made some mistakes, and we all learned from them, I hope. But global cash flow of your borrower was something that we kind of didn't really focus on, and the staying power and the ability for those projects to be completed and sold, and that's where a lot of us got burned.
But let's fast forward to 2012. 2012, I have two institutions who have both opened up loan origination, we'll call them, in New York City. We allow you from the Garden State to come over here, that you've been here, okay? You and I are...
I was born in the Bronx.
Okay, so you had your passport, you went over there. You've come here and you've opened up these originations to do business. Isn't there enough business in New Jersey for both of you?
Sure. You're welcome to come over there.
The reasoning. My question is the
multifamily is a very desirable product, and there's much more of it over here. There's plenty more real estate lending opportunities over here, and we've been able to enjoy some of them, and there's plenty of room for all of us at this stage.
Yeah. So here's the question: M&T, who's been around, people really don't believe it. It was once called Manufacturers and Traders Bank, and it's headquartered in Buffalo, and a couple of your chief executives spend 1 or 2 days a week up in Buffalo. They've been here for many years. You've built a great business in the real estate, but your middle market business is a little slower. What do you attribute that to?
You know, outside of New York, our middle market business is actually tremendous, and that's not to say we don't have a large business here in New York as well. You know, we're number one in market share in Baltimore County. We're, I think, number two in market share in DC. And New York, it's a business that we entered only a few years ago, maybe.
No, I think M&T in New York City, I think the opportunities are there. I mean, we spoke before, and Kevin said, look, he's a real estate lender. He's not anything else. M&T has been a very competent real estate lender.
Oh, absolutely.
And also, I mean, you've recently entered the healthcare arena, making a loan like the Peconic Bay Medical Center, like a $31 million loan. And I know in the state of New Jersey, look at this, they went from Buffalo over there. Ira did a lot of business in the healthcare arena in New Jersey.
That's right.
So, you know, but that leads into another question. Everybody likes multifamily, but there are a lot of asset classes and a lot of opportunities over there. Where do you see, as a banker in 2012 and 2013, so the bank can earn enough money and make the profitability, which markets do you see Flushing maybe increasing their exposure in the next year? And I'm going to ask that same question to Kevin.
Well, our most desired class would be the multifamily. From the balance sheet perspective, given the current interest rate levels, you need the asset growth. We have the benefit of lower interest rates, so we were able to build a margin based on a lower cost of funds. Our biggest concern really is 3 or 4, maybe 5 years out, if rates should rise and we have too much in a 5 or 7 year interest rate scenario. So we've, again, taken a more balanced approach. We've built out a business banking platform that has the availability to do C&I lending, although much different in asset class from real estate. It does provide us with greater flexibility in our interest rate margin perspective. Professionals, doctors, attorneys, some credit companies, a little bit of accounts receivable financing, some of it's uncommitted lines. So we're able to kind of fund some transactions short term at wider spreads, and we have some ability to get out of those transactions quicker if we need to. We're also looking to become a bit more active in the commercial real estate market. Not something to compete with some of the larger banks, but we focus mostly in the boroughs of New York City, predominantly Brooklyn, Queens, a little bit in the Bronx for retail.
Now, you know, we just brought up the Bronx, you know, since Kevin grew up and he was born in the Bronx. So here's my question, and I hear this and I'd like to throw it to everyone. You talk about mixed use. How do you look at a mixed use property, which, you know, and it's different by the boroughs, okay? And, you know, Dominic and I are Brooklyn boys. We grew up in Brooklyn, you know, where you have retail on the ground floor and then you have apartments on top. When you're underwriting that type of loan, how do you look at the credit? I mean, you're happy with years ago you'd be happy with a bakery or you may be happy with an appetizing store. Today you're looking at a credit tenant.
We
right?
look at the percentage of income from residential versus commercial, and we have different underwriting parameters for that. And if it's at least 2/3 residential, we feel a lot more comfortable about it, because those tenants downstairs are generally, you know, they can come and go. Depends on who they are, whether they're credit tenants or mom and pops. And that's really an important part of it. But many of the buildings in the city, I guess they refer to them as taxpayers. The guy on the first floor is paying the taxes, and the tenants upstairs are, you know, or it's just like the gas stations where they say the gas pays the rent and the repairs make the profits. You know, but that's how we evaluate.
Now you've hired a very established C&I lender to do more C&I. Where do you want to grow, and where do you see the opportunities in C&I?
We see the opportunities in middle market, obviously, healthcare industry, and we're looking specifically at the boroughs. You know, we believe that there is a market out there that is untapped. That is, you know, some of the national players, you know, the big names that, you know, I won't mention here, are just not paying close enough attention to some of these smaller customers that we can make some money on, that they look at and say they're not big enough for us. So that's where we're focusing, the boroughs and Long Island.
Are you looking in the boroughs these days?
We are. You know, most of our portfolio is New York City. is Manhattan. We like to say we go where the subway goes. I think that's, location is very important to us. Sponsorship is sort of number one, and we'll more or less follow.
I heard you made some loans in Clifton, New Jersey, so you've gone across state lines.
Well, we will. We'll follow. We'll follow a borrower, and sponsorship is number one. But absolutely, 5 boroughs. Long Island, really tri-state area, and we do have a lending team in New Jersey as well.
How do we look at with regard to asset classes? How do we look at the retail segment? I mean, because retail is broken down into a variety of categories. Growing up, I remember my late father-in-law had a drugstore. It was in Borough Park. It was, that was when they were the drugstore. If you had a family drugstore, you were Doc, and it was a different world. Today, it's Walgreens, CVS, it's Rite Aid. It's these major things, and these drugstores are not drugstores. In many cases, especially with Duane Reade in New York City, in Manhattan, many of them have Doc in the boxes today. Which is the situation. They have Doc in the boxes. They have supermarkets. I mean, they have a 4,000 square foot supermarket, and they're 24/7. They're 7 days a week. What asset class in retail do you people like, and what asset class are you a little cautious about? Because I brought up before the subject of health clubs. There's the Equinox, which is the high end. Then there's their Family Blink, and then there's Planet Fitness, and Golds, and all the rest.
We've got a couple of health clubs, but only with very strong personal guarantors, because I see that as a concern. It's a fad, and there's a number of them springing up, and I think that may be overbuilt. But when it comes to drugstores, you can't do any better than CVS and Walgreens. Those are prime credits, and we love them. Rite Aid is another matter. And years ago, we wouldn't do Duane Reade. We wouldn't touch them, and now I guess CVS took them over.
No, it's owned by Walgreens, so
Walgreens,
you're in a situation. But it brings up a subject of what's in and what's out. Retail, a lot of the retail today, 15 years ago, there were companies like Sam Goody, Borders, there were bookstores, there were record stores. You don't have these types of business. So when you're making a loan, and nobody has a crystal ball to know that the book business would be out of business over here, or there wouldn't be Circuit City. There's the consolidation because e-commerce has taken over such a big situation. Each one of you are with publicly held companies, and you have a responsibility to your shareholders to be fiduciaries. How do you look at certain markets that I'll bring up? Hospitality. Hospitality, it's a day-to-day operation. Now, I know that M&T has done well with established, well-capitalized people over here. How do you, Frank or Kevin, have you?
Well, we've approached it being a community-based bank from a perspective of location. New York City being, the world of immigration, in every community there's a need for facilities for extended family to come stay. The immigration from the Middle East recently, and China and Korea, many of these immigration classes have gone to neighborhoods where there are no hotels.
Even though you are Flushing Bank and your office is in Lake Success, Flushing is the garden spot of 80 different dialects of Asian people.
It is a trend.
Okay, but it's. Would you lend to these to the hotel business?
We actually have, and we have found it to be, again, knowing the operator, knowing the demographics of our neighborhoods to be fairly stable asset classes. As I said earlier, people coming from China and Korea and from the Middle East, they have extended family that come quite frequently throughout the year.
No, I think your point is well valid. What about yourself?
We haven't done any hotels. We've looked at one or two, but we couldn't get comfortable with the underwriting that it required. We do have a couple of catering facilities. I guess you'd call them wedding factories, and they've done phenomenal over the last few years, especially those in the mid level as opposed to the high end. But
Mike, I think you heard most people say, everybody here on the show has said it, and it's about strong personal guarantees, or it's about sponsorship. I mean, you know, retail is retail, and you're not gonna. It's hard to say what do I like, what do I not like. But if I have a deal that I don't like, but has a strong personal guarantee,
you bring up the term strong personal guarantee, but every one of you sitting here, if I said to you multifamily residential, because all of your competitors don't require personal guarantees.
It's a non-recourse.
It's a different. It's non-recourse.
It's
a different
non-recourse
world.
but that's a
with a
different
carve-out.
world. It's a cash flow world. I mean,
Yeah.
you know, especially in Brooklyn and Queens, we know that you know, with rent stabilization laws, you know, as long as your income is sufficient to carry the debt today, it should be sufficient to carry the debt tomorrow.
The big question on multifamily, and I'm a big advocate and I love multifamily, and we brought it up prior to the show, was how much can somebody pay in rent? You know, where does somebody say, Uncle, I can't pay this type of rent? You know, people can only earn up to a certain point. Where is this uncle situation? Because, you know, there are certain neighborhoods, you know, in Brooklyn, everything's great, but, you know, Coney Island's an hour transportation. It's like, you know.
But that's what I was going to say. I mean, you know, it's hard to answer that question. My answer to that would be, it depends. Is the property in Bay Ridge, Brooklyn? Is it in Flushing, Queens? Is it on 85th Street and Park Avenue in Manhattan? Each of those properties points has a different uncle point. And
Yeah, you know, everyone wants to be in New York, right? And so it seems that you have a few.
I mean, for a kid of your age, you have at least have some gray hair, but you're the youngest here.
Well, you know, you have a shrinking supply of quality rentals as buildings are converted to condos, and it always seems as if as rents rise, people are willing to make do with less space in their shares, and you know, 2 or 3 people are renting the same.
But you bring up you bring up the term condo, and that's something I failed to bring up. How do you look at the for sale market today in 2012 as compared to what you were talking about when you did construction loans in 2005? Is the for sale business an opportunity, something, or is that something that you're still a little cautious,
we're queasy about it. You know, we're still queasy about for sale, especially in condo. You know, I mean, every builder we talk to today is putting a shovel in the ground for a rental, for a multifamily building. I mean, that's where everybody sees it going.
We've seen many failed condo projects converted to rental projects because that was the only feasible way out of the mess.
Now, how do you look at it? You know, New York City has a different situation for sale and for rental. A lot of the buildings that were constructed in New York were built because of tax abatements. In Lower Manhattan, a number of years ago in the 90s, we converted office buildings under a 421G, which was a 15-year tax abatement. Then there was the 421A, which was the tax, you know, a phase-in of taxes. Today, there aren't tax benefits available. How do you, I mean, and in New Jersey, there were pilot programs in Jersey City and other parts of the market. When you look at underwriting a deal, taxes can represent in New York City up to 30% of your operating expense. How do you look at that in the suburbs?
I'd say probably in Nassau County, probably equal, and could be rising. So it poses a challenge because obviously it reduces the amount of income available to service debt. From our perspective, we generally look at the last several years of taxes, 2 or 3 years, and try to get a handle on where the escalation point is. And we would prefer to build a model that predicts where taxes could be 3 or 4 years out. And when we make our credit decision today, we want to ensure that we capture that exposure 3 years down the line today, because that is a big number.
You bring up a very interesting point about interest exposure. Today, certain loans, I'm not saying any of you are doing them at this rate, but a borrower can lock in a multifamily loan perhaps as low as 3.25% for a 5-year loan,
A lot less than that. That's what we've heard.
Okay, I've heard
Not
below.
many of the guys here.
Not here, but that's why I preface this.
we're here.
I said some people are offering as low as 3% on a 5-year loan. How do you know, these rates can only stay this rate for a certain period of time. How do you protect for the interest rate later on? You're underwriting at this number, and expenses and the rest.
No,
How do you look?
all of our loans, we try to keep it to a 5-year reset. And all of our loans, we match fund, not on an individual basis, but on a batch basis. We look and see where our maturities are, and we borrow long from the Home Loan Bank at rates that protect us to keep our costs down. But we know that one of these days, Mr. Bernanke is going to have a change of his heart, or the world is going to change, and these rates are going to snap
We
back up.
qualify the borrower at a rate that's 100 basis point higher. Is that the right number? Who knows?
Yeah,
But
I mean, there was
we
something called
qualify
debt
in
yield
both
at one
ways.
time. People were looking at debt
that's-
yield. And what kind of debt yield do you?
Right. So it used to be that the constraints in sizing a loan were loan to value, and that you'd expect a 130 debt service coverage or 120 debt service coverage, and that's the pitfall today, as you point out, is that virtually every property works at a 120 coverage when rates are as low as they are. And so for us, it's not so much a sizing to a debt yield on a going in basis, but rather what it's going to be on the takeout from amortization, net of amortization and of any rental.
We do a stress
NOI
test.
growth. And
What-
so we're looking for, say, a 10 debt yield on the back end.
We do a stress test to say what's going to happen in 5 years if rates are up at least 300
Right.
bips.
Right.
And will they be able to carry this loan, or are we going to be having a agonizing reappraisal in 5 years when and when the rate goes up and the borrower says, I can't carry it?
Would you make the loan if you didn't?
We'll stress test it and make it only if we think he can, based on what we think is going to happen between
Right.
now and 5 years from now.
That's the same issue we have. I mean, we stress it by 100 basis points, but what says 100 basis points is good enough?
Yeah, for today. But I think between now and 5 years, 300's a conservative estimate of what. I mean, these historical rates, it can't stay like this forever. And if you look back at what rates were 5 or 10 years ago, 300 more than today is an easy
LIBOR was
assumption.
5 or 6%.
Yeah,
Can we look back 20 years ago when I remember prime was 18%?
Sure.
So, I mean, the
First
world.
mortgage on my house was 16 and 5/8.
Wow.
So you look at it over there. I hear neighborhoods, I hear Hudson County, I hear parts of Brooklyn, and I mean, I only have like a minute left. Do you think there are any really great opportunity, any great neighborhoods? Do we, especially since I have two New Jersey-based lenders, do you see Newark one of these days coming back? Do we see Harrison? Do we see Bayonne?
I don't see, personally, I don't see Newark coming back. What we see coming back are urban areas like Bloomfield, Clifton, areas like that where people are selling their houses and want to be in a more urban environment, in a train, close to the city.
Yeah, Newark is more commercial development now, office product, which we won't go near. Jersey City, we see some apartments, but no, I don't see an apartment renaissance in
Frank, Nassau, Suffolk County?
Suffolk, I'm not very familiar with. It's much bigger than Nassau County, so I really couldn't offer any opinion on that. But Nassau County has tremendous potential. I think they have to really address some zoning issues to allow some development above a one-story commercial building, some wonderful downtown areas. Merrick has done a fantastic job in the last 15 years. If they can get these downtown areas together, they'll be fine.
So I'd like to say I hope that in 2013 you'll all come back and we'll see if our crystal apple was correct in some of your ideas and your predictions. But I'd like to thank Dominic, Matt, Kevin, and Frank, and I'll see you next week.